From the very moment markets opened on the morning that trade titans clashed, something seismic rippled through Wall Street, a shock that erased billions from the valuation of one of America's most iconic industrial sectors. Picture this: a sudden plunge, not from a quarterly miss, not from a recession scare, but from trade policy and geopolitical firepower. In a matter of hours, more than $12 billion in market value evaporated, wiped clean like chalk dust on a blackboard, as investors awoke to an unexpected and dramatic escalation in North American trade tensions. This isn't a story about fleeting market volatility. This is a story about policy meets power, about what happens when two of the world's most integrated economies suddenly choose confrontation over cooperation, and about how one country's strategic response to tariffs shook the foundation of another country's industrial core. To understand the seismic shock that rattled U.S. steel, you must first understand the backdrop, the tangled web of decades-long trade interdependence between the United States and Canada. The U.S. and Canada are not distant trade partners. They are intertwined neighbors, with billions of dollars worth of goods crossing their shared border each year. At the heart of this relationship are commodities like steel and aluminum, raw materials that power infrastructure, defense production, automotive manufacturing, construction, and nearly every sector of modern industry. When news broke that the United States government had reimposed sweeping tariffs on imported steel and aluminum, including a 25% tariff across the board, markets were already nervous. What many traders and analysts failed to appreciate, however, was Canada's fierce and immediate counterpunch, a measured yet powerful retaliatory tariff regime that targeted American steel and aluminum exports worth roughly $12.6 billion and beyond. In that moment, Wall Street's calm turned to chaos. Not because steel is glamorous, far from it, but because steel is foundational. It is the backbone of modern economies. Disruption in steel markets sends shockwaves into supply chains, corporate profitability, and investor confidence. It affects everything from construction and energy projects to automotive jobs and defense manufacturing. And the key player in this dramatic turn of events? Canada. A country long viewed as a steady partner in North American commerce, suddenly became the catalyst for one of the most volatile trade shocks seen in years. Let's rewind and break down what happened with precision, because this is where the narrative moves from rumor and hype into cold, hard economic reality. In early 2025, the United States government announced an escalation of tariffs on imported steel and aluminum products. These new tariffs were broad and applied to all global suppliers, including long-standing partners like Canada, Mexico, and members of the European Union. For steel and aluminum, the tariffs were set at 25%, a steep barrier intended to protect domestic producers, but one that instantly rippled across global markets. The U.S. justification centered on national security and a desire to bolster American manufacturing. The narrative from Washington was simple: protecting steel and aluminum producers from foreign competition would, in theory, strengthen domestic capacity and jobs. But trade economists and industry analysts warn that such tariffs rarely work as cleanly in practice as they do in political speeches. What followed next was a calculated response from Canada. Not knee-jerk, not weak, but strategically measured. Within hours of the U.S. tariff announcement taking effect, the government of Canada announced reciprocal tariffs on U.S. steel and aluminum products totaling nearly $12.6 billion, among other levies on U.S. goods. This dollar-for-dollar strategy, announced by Canada's finance leaders, was designed not only to protect Canada's own industries, but also to signal to American producers and investors that retaliation would be swift and precise. For a country whose exports are deeply integrated into U.S. supply chains, particularly in steel, aluminum, automotive parts, and machinery components, this was not a move taken lightly. It was a measured blow designed to shift leverage in the trade discourse. Now imagine the response in financial markets. Investors, algorithms, and institutional funds reacted instantly. Stocks tied to U.S. steel producers, suppliers, and industrial demand chains began to tumble. Futures markets reevaluated risk across commodities. Currency markets momentarily priced in broader economic uncertainty. And just like that, billions in market value were wiped out. Not due to earnings misses, not due to poor balance sheets, but due to policy and geopolitical strategy. This dramatic reaction is not simply about headline numbers or political rhetoric. It's about the real economics of production, trade flows, and supply chain interdependence. You see, Canada isn't just another steel supplier to the U.S. It is the supplier who accounts for a massive share of American steel and aluminum imports. Decades of integrated production networks mean that Canadian steel feeds directly into U.S. industries that operate on razor-thin margins and tight delivery schedules. Disrupt that flow, and the effect is immediate. Tariffs don't just add cost, they introduce friction. And in the steel market, where price competition is fierce and demand can be elastic, that friction translates into lost orders, shifted supplier relationships, and repriced futures contracts. When Canada reciprocated with tariffs of its own, the message to Wall Street was clear. We are not a passive trading partner in this fight. In fact, Canada's response essentially shut off nearly $12 billion worth of U.S. steel exports in one policy decision, a dramatic figure that shocked industrial analysts and investors alike. But let's dig deeper, because there's more to this story than tariffs and stock prices. Trade battles like this don't play out in a vacuum. They unfold against a backdrop of global market pressures, supply chain bottlenecks, and shifting geopolitical alliances. Even before this tariff escalation, global steel markets were already under stress due to overcapacity in some regions, fluctuating demand after pandemic recovery cycles, and competitive pressures from low-cost producers abroad. Canada had been grappling with these realities, and its metal industry leaders were vocal about the need for government support as competitive pressures mounted. So when the U.S. slapped on heavy tariffs, Canada's leaders understood both the immediate economic pain and the strategic leverage they possessed. Rather than absorb the tariff shock quietly, Ottawa chose to fight back, not with rhetoric alone, but with economic policy that directly hit U.S. export flows. The ripple effect of this decision extends far beyond the steel sector. It has reignited debates about supply chain resilience, about the limits of protectionist policies, and about how deeply intertwined modern economies have become, even those with tense political disagreements. Investors are now asking hard questions. If integrated trading partners can weaponize tariffs, what does that mean for cross-border investments? What happens to industries that depend on seamless flow of materials? And most importantly, how should risk be priced in an era where trade policy can shift overnight with massive market consequences? These are the questions that now haunt boardrooms on Wall Street. And it's here, at this intersection of economics, policy, and finance, that the market's jaw-dropping reaction makes sense. Because this is not just a tariff story. It is a story about market psychology, risk premiering in real time, and the fragility of assumptions that underlie industrial equity valuations. Stocks can rise on operational excellence, but when policy threatens revenue streams and raises input costs unpredictably, valuations can plummet just as quickly. What happened to U.S. Steel on that fateful day is a prime example. Billions vaporized not because the companies were weak, but because a cornerstone assumption that cross-border trade would remain stable was suddenly undermined. The market repriced risk, recalibrated expectations, and delivered a wake-up call. In 21st century global capitalism, policy risk is market risk. In the next segment, we will dive even deeper, exploring how specific companies were affected, how global supply chains are shifting in response, and what this means for investors, industries, and trade relations going forward. When markets reopened, the immediate numbers told one story. Billions lost, share prices down, futures contracts re-rated, but the real lasting impact unfolded behind the scenes, where corporate boards, supply chain analysts, and institutional traders reassessed risk in real time. One by one, the companies that once stood as titans of American steel found themselves grappling with a new reality, a marketplace no longer defined solely by production capacity or cost efficiency, but by geopolitical fragility. The steel sector in the United States has long been concentrated among a handful of major producers, legacy firms with sprawling operations, deep ties to automotive and construction supply chains, and balance sheets shaped by decades of cyclical boom and bust cycles. These firms had for years operated under a common assumption that access to Canadian raw materials and semi-finished products would remain reliable and cost-effective. Canada's steel and aluminum exports were not just supplemental, they were integral. When that assumption was shattered, the reaction was swift. Production forecasts were revised downward. Contractual obligations with manufacturers were put at risk, and perhaps most critically, capital expenditure plans were suddenly thrown into uncertainty. Consider the executives at the largest U.S. steel producers. Just weeks before the tariff escalation, many had outlined ambitious plans for modernization, investments in electric arc furnaces, expansion of specialty steel lines, and automation to reduce long-term production costs. These plans were grounded in an expectation of stable input prices and predictable supply chain flows. But with new tariffs and reciprocal actions across the border, the cost of imported steel inputs jumped overnight. That meant profit margins were compressed before the ink was dry on investor presentations. For investors, this was a shift from conventional risk analysis to a form of geopolitical risk that had until recently seemed distant. Analysts who once focused exclusively on quarterly revenue and EBITDA margins were now forced to contend with tariffs, trade disputes, and supply chain bottlenecks as core valuation inputs. Discounted cash flow models were adjusted not because of changing consumer demand, but because of policy uncertainty and tit-for-tat trade escalation. What does this mean in practical terms? It means that hedge funds and institutional investors, always on the hunt for alpha, began reallocating capital away from steel and the broader industrial sector, not because these companies were inherently unprofitable, but because the risk-adjusted return profile had fundamentally changed. This shift in capital allocation had knock-on effects. Industrial ETFs with heavy exposure to U.S. steel began seeing outflows. Credit analysts revisited debt ratings for mid-tier producers, and banks that traditionally underwrote industrial bonds took a more cautious approach to future financings. The market was signaling something important. Policy risk can quickly eclipse operational fundamentals. At the same time, Canadian producers, particularly those with diversified global markets, found themselves in a unique position. While their own government's retaliatory tariffs were intended to defend domestic interests, Canadian steel companies were, in many cases, less dependent on the U.S. than their American counterparts were on Canada. Their export networks extended into Asia, Europe, and Latin America, and the diversification insulated them to some degree from the immediate shock. This disparity, where one side of a deeply integrated trade relationship is more exposed than the other, is precisely what made the market reaction so dramatic. U.S. producers suddenly found themselves at a competitive disadvantage not because of production inefficiency, but because of trade policy asymmetry, and the consequences didn't stop at steel mills and industrial parks. Downstream industries began signaling their own concerns. Automotive manufacturers, which rely on a seamless flow of steel inputs, started publicly disclosing potential production slowdowns due to input cost volatility. Construction companies warned of price escalation in long-term contracts, and energy sector firms, particularly those involved in infrastructure and pipeline work, revised project budgets to account for potential cost inflation in raw materials. In other words, the shockwaves from a tariff dispute were no longer contained. They had begun to propagate through entire industrial ecosystems. But perhaps the most revealing impact came not from the numbers alone, but from how corporate leadership framed the crisis. CEO letters and earnings calls shifted tone dramatically. Where there was once optimism about domestic growth and manufacturing strength, there was now caution. References to policy uncertainty, input cost pressure, and supply chain realignment. These phrases, while seemingly innocuous, signal a deeper strategic reorientation. When management teams openly acknowledge trade policy as a material risk factor, investors take note because it means that external non-economic factors have a seat at the table in business planning. And investors weren't the only ones paying attention. Regulators, economists, and industry associations began publishing analysis, projections, and recommendations almost in real time. The narrative in financial media outlets shifted from standard market reporting to in-depth examinations of trade policy impacts, tariff mechanics, and supply chain resilience. Suddenly, topics that had once been confined to academic journals, such as tariff pass-through rates, elasticity of demand for steel products, and input substitution effects, were trending discussion points among traders, analysts, and everyday investors. This was a turning point. The market was no longer simply reacting to a policy change. It was evaluating the implications, integrating them into expectations, and pricing them accordingly. Yet it's important to understand the psychology behind the market's reaction. Financial markets are forward-looking. They don't just price what is happening now. They price what participants expect to happen. And in this case, what markets began to fear was not simply the immediate tariff costs, but the prospect of a protracted trade conflict. What if this escalation was just the beginning? What if other countries decided to join Canada's approach? Could steel and aluminum supply chains face fragmentation on a global scale? These questions, once theoretical, suddenly became prominent in investor models. Now consider this: when markets price in escalation risk, they often do so aggressively. Why? Because the potential downside, broad economic slowdowns, shrinking demand, and higher production costs, can erode earnings across multiple sectors. This is not just about steel, it's about the anticipation of interconnected impacts across the industrial landscape. And investors responded accordingly. Risk premiums rose, equity valuations were discounted, and capital flowed toward perceived safe havens, technologies, services, and sectors with lower exposure to global trade volatility. But even as capital rotated, another trend emerged: a renewed focus on supply chain sovereignty. Corporations began to publicly declare strategies for reducing dependence on cross-border inputs. Some announced plans to onshore production, while others explored alternative suppliers in countries not involved in the trade dispute. These moves, while strategically sound, introduced a new layer of cost and complexity, and markets priced in those future expense expectations almost as quickly as they priced the initial tariff shock. This trend toward supply chain diversification and reshoring could have long-term benefits, but in the short term, it carries cost implications that investors must weigh. Onshoring production, after all, is not cheap. It requires capital investment, workforce development, and time, not to mention navigating different regulatory environments. That brings us to a crucial element of this unfolding narrative: the role of government policy as both a disruptor and a catalyst for strategic realignment. As the dust settles from the immediate market shock, the broader economic consequences are starting to become visible. What began as a bilateral trade dispute between Canada and the United States is now rippling outward, affecting global supply chains, trade balances, and investor behavior across continents. Economists warn that the $12 billion in vaporized market value is merely the tip of the iceberg, the visible symbol of a deeper systemic recalibration. One of the first arenas to feel the aftershock is global trade. Steel and aluminum are commodities with extensive international markets, and when tariffs disrupt the North American supply chain, other regions inevitably adjust. European and Asian producers have begun recalibrating export strategies, either seeking to fill the gap left by U.S. market contractions or adjusting pricing to compete with Canadian resilience. In practical terms, this means price volatility for industrial metals, fluctuating futures contracts, and a wave of uncertainty that extends to manufacturing hubs worldwide. Currency markets have also reacted. The U.S. dollar, long considered a safe haven, has experienced short-term volatility as traders hedge against potential negative growth outcomes from industrial slowdowns. Meanwhile, the Canadian dollar has strengthened modestly, reflecting confidence in government strategy and a resilient export sector that remains diversified globally. These currency shifts feed directly into import-export calculations, affecting multinational corporations' balance sheets, profit forecasts, and strategic planning. For investors, this environment creates both risk and opportunity. Traditional portfolios heavily weighted in U.S. industrials may underperform in the short term, particularly if companies remain exposed to cross-border supply chain disruptions. However, alternative investments, such as diversified ETFs, including global steel suppliers, materials innovation firms, or sectors less sensitive to trade tensions, have begun to attract capital. The smart money is increasingly considering geopolitical risk as a core element of portfolio design rather than a secondary factor. One area of strategic interest is technological adaptation within the steel industry. Companies facing higher input costs and supply chain uncertainty are investing in automation, robotics, and advanced manufacturing techniques to reduce dependency on imported materials. These investments, while expensive in the short term, promise longer-term resilience, higher efficiency, and the ability to pivot production more flexibly in response to future trade disruptions. For investors, tracking companies' strategic moves in this domain is becoming as important as analyzing quarterly earnings. The ripple effect also extends to labor markets. Steel mills, fabrication plants, and downstream manufacturing operations face a choice: absorb higher costs, pass them on to customers, or restructure operations. In some cases, this has already resulted in temporary production slowdowns or adjusted hiring plans, affecting thousands of workers across multiple sectors. Investors must consider not only corporate balance sheets, but also human capital implications, as labor productivity, morale, and retention play a role in long-term company performance. From a policy perspective, this event marks a critical inflection point. Governments on both sides are being closely watched by industry groups, investors, and global partners. How the U.S. responds to Canada's measured retaliation will determine not only near-term market recovery, but also long-term credibility of trade negotiations. Observers note that retaliatory tariffs are a signal of strategic capability, a demonstration that a country can protect its domestic interests and enforce rules without escalating into uncontrolled conflict. However, missteps could trigger a spiral of tit-for-tat measures, impacting not just steel, but a host of other critical sectors, including automotive, aerospace, energy, and construction. International organizations and trade watchdogs are also stepping into the conversation. Analysts from the World Trade Organization and independent think tanks are publishing risk assessments, scenario analyses, and supply chain forecasts, emphasizing that modern trade is more interconnected than ever. One disruption, particularly in a high-demand commodity like steel, can have cascading effects across multiple continents. Investors and executives are paying close attention, understanding that policy-driven volatility is a new constant in global markets. Now consider the broader macroeconomic implications. Steel and aluminum are not isolated sectors. They serve as leading indicators for industrial health. When supply chains are disrupted, downstream industries face higher input costs, which can translate into inflationary pressures, delayed infrastructure projects, and constrained economic growth. Central banks may respond with monetary policy adjustments, interest rate considerations, and market interventions, all of which feed back into equity valuations, bond markets, and investor confidence. In essence, a policy action that impacts $12 billion of steel exports has the potential to influence macroeconomic policy far beyond the immediate dispute. For everyday investors, the takeaway is both cautionary and instructive. First, the events highlight the importance of diversification, not just across industries, but across geopolitical exposures. Portfolios overly concentrated in domestic industrials may experience outsized volatility in response to trade policy shifts. Second, investors should monitor companies' supply chain resilience strategies, including onshoring, diversification of suppliers, and technological adaptation. Firms that can pivot effectively are more likely to weather trade shocks without major disruption. Finally, it underscores the value of forward-looking analysis, understanding not just the current market value but the risk profile of investments in a world where policy shocks can arrive overnight. The Canada-U.S. steel dispute also presents broader lessons for policymakers, corporations, and investors alike. For policymakers, it demonstrates the double-edged nature of tariffs. They may protect domestic industries in theory, but can also provoke retaliation that undermines broader economic interests. For corporations, it highlights the necessity of integrated risk management, flexible production strategies, and continuous monitoring of geopolitical developments. For investors, it emphasizes that market valuations are increasingly tied to non-financial factors, including political strategy, trade policy, and global supply chain interconnectivity. Looking ahead, the market may gradually stabilize, but the event will leave a lasting imprint. Analysts predict a period of heightened market sensitivity, where even minor policy statements, bilateral meetings, or international announcements could trigger outsized market reactions. Companies that act proactively, restructuring supply chains, investing in efficiency, and hedging geopolitical exposure, will likely outperform those that wait for policy clarity. In essence, the Canada-U.S. steel dispute is a wake-up call for a new era of trade-aware investing. Ultimately, this event is about more than numbers. It's about understanding the interplay between policy, markets, and strategy, and recognizing that global economic systems are delicate, deeply interconnected, and increasingly influenced by rapid shifts in government action. Wall Street may have been shell-shocked by the $12 billion overnight wipeout, but the lessons extend far beyond a single sector or market move. They reach into the heart of how investors, corporations, and policymakers must navigate a world where every decision, every tariff, and every trade measure can have immediate and profound consequences. As investors digest these events, the challenge is clear: adapt, anticipate, and align strategies with the reality that market stability is contingent on political as well as economic factors. Those who do will not only survive disruptions like this, but will position themselves to capitalize on the opportunities created when others fail to respond effectively. The Canada-U.S. steel clash serves as a potent reminder. In modern global finance, knowledge is power, foresight is profit, and agility is survival.